Hey, John, it's really good to see you. Today, we are talking about kind of some breaking news, what's happening with Silicon Valley Bank and the markets. We are recording this on a Monday afternoon. We want everybody to know that there are still a lot of moving parts, but you made it a priority to be communicative with clients, so we wanted to get on top of this. So let's just get in. The Fed is moving to stem a U.S. banking crisis following the rapid collapse of Silicon Valley Bank. So let's start with what is most important for your clients. What do they need to know?
Well, the difference in the banks that our clients are have their money with versus SVP is substantial, right? And the banks that our clients have their money in are systemically important banks, right? The too big to fail banks, banks with solid financial records and stable records and outlooks going forward. So, in comparison to the two, I believe our clients are at very low risk of what happened to the investors with SVP.
Right.
So that's important. And systemically, the actual systematically important banks, the big name brand banks, are actually very well capitalized right now too. So that's another type of positive that we haven't really heard too much about.
Right. So, John, let's just break that down a little bit more because these non-systemically important banks like Silicon Valley, their investments were heavily weighted in bonds, and that was probably not a good investment decision.
Yeah, I think 14 months ago, we moved our clients out of bonds.
Right.
It really, their problem was twofold. Number one, they had a lot of in Silicon Valley's instance, they had a lot of commercial deposits, but they didn't have any other way to make money. They didn't have a lot of loans or mortgages or auto loans like a lot of these banks do. So that was the first problem. The second problem is they went ahead and made a big bet on bonds in a zero interest rate environment with the Fed spiking interest rates. So as one analyst, very callously put it, they were negligent and mismanaged of the investments. And they didn't hedge against that interest rate risk, and it blew up on them. Mm-hmm. So, and we kind of look at, again, a comparison. SVP had 50% of its investments in bonds, whereas some of these systemically important banks, 25%. So that was what really caused it. And then as soon as, of course, having 50% of your holdings in long-term bonds, they took a huge loss, which they announced last week. A lot of these corporate depositors, obviously it's because their business is on the line, took the money out. Then the rumors flew of a bank runoff, and that's where we got to the SVP.
Right. Okay. Well, thank you for that explanation. Again, just how this comes back to the clients or to the average investor. I don't know if this is average, but the FDIC only insures deposits in banks up to $250,000. So if you have more than $250,000 in the bank, what should you be doing?
Be diverse.
Yeah.
Be diverse. If you're a lover of banks, be diverse. Now's not the time to go for those small regional banks paying a little bit higher in interest rates. Whether it's an insurance company or a bank, right? Brookstone vets these banks. They want to know that these banks are financially stable. Much the same way that if I ever do an insurance vehicle, we want the most financially superior companies. So have multiple banks if you're going to carry over that 250,000, because as I said earlier, the SVP beatdown that these companies are taking, a lot of them were way beyond the $250,000 threshold. So that's a big lesson for people to understand.
Right. So again, as we work to educate everybody who's watching this video, how is this different from the 2008 banking and financial crisis?
Yeah, well, again, there are some similarities. There was a lot of mismanagement, but there was less regulations. This was prior to the Dodd-Frank, and you had the banks of the 2008 financial crisis and highly volatile derivatives. So now, the banks, the systemically important banks are, as I said, they're much more capitalized. and they have a lot more regulations after the Dodd-Frank. And they have the ability to make money in a rising interest rate environment with those loans and mortgage rates that SVP and these other banks can't. Now, the word of warning is, are we done with this? Many analysts say no. This is just the tip of the iceberg in terms of the smaller regional banks. But those same analysts feel comfortable with the systemically important banks, as does Brookstone Capital Management. So what I do believe this is going to do, it's going to erode confidence in the banking system yet again, and this is going to cause market volatility. So, for our clients, we're doing some more proactive things this week. As a matter of fact, after we record, I'll be on a call with my analysts to discuss some changes that we're looking at.
Right. Okay. Well, John, talking this through with you was incredibly valuable. Of course, it's very understandable if people feel anxious, though, after listening to these headlines.
Absolutely.
If they have any questions for you, what's the best way to reach you?
Well, you can give us a call at the office, 858-935-6210, or visit our website, www.gosecurus.com. And before we go, Aaron, I've got to say thank you to all the people, the production, the editing, and the legal who review these videos, because we're going to try to get this video out and turned around in one day. So we want to get this information out. So thank you to all those people that worked hard for that.
Yeah, you do have the best team around, John, that's for sure. Thank you very much for your time today.
Thank you, Aaron.